You're standing at the pharmacy counter, paying for a prescription with your debit card. Totally ordinary moment. But there's a specific type of account that could have paid for that exact same prescription, pre-tax, tax-free growth, and tax-free when you spend it. 3 separate tax breaks on one purchase. And there's a decent chance you either don't have this account, or you have it, and have no idea what it actually does. It's called an HSA, a health savings account, and 2026 is a particularly important year for it, because new federal rules just expanded who has access to it, and almost nobody is using it correctly even when they qualify. In this video, I'm breaking down exactly what an HSA is, the 2026 numbers, and the specific strategy that turns this account from a place to pay medical bills into one of the most tax-efficient accounts available in the U.S. tax code. Quick note, I'm not a financial or tax advisor. This is a framework based on IRS data, not personalized advice. And if this kind of numbers first breakdown is useful to you, subscribing helps this channel keep making it. Let's get into it. Here's the confusing part about HSAs. Most people who have one only ever use it like a special debit card for doctor visits and prescriptions. And technically that's fine, that's allowed. But it's also the least powerful way to use this account. The reason most people never go further than that is simple. Nobody explains that an HSA can also function as an investment account, and eventually, as a second retirement account with rules that work differently, and in some ways better, than a 401k or IRA. And 2026 specifically expanded who qualifies, under a provision passed in 2025, called the One Big Beautiful Bill Act. 2 major eligibility changes took effect starting January 1, 2026. Certain bronze and catastrophic marketplace health plans now count as HSA compatible even if they don't meet the usual deductible rules. And certain qualifying direct primary care arrangements no longer disqualify you from having an HSA. Separately, a permanent rule now lets qualifying telehealth and remote care services be covered before your deductible is met without breaking your HSA eligibility. So even if you assumed you didn't qualify before, that might have changed this year specifically. Let's look at the actual numbers behind why this account is such a big deal. For 2026, you can contribute up to $4,400 to an HSA if you have individual coverage, or $8,750 for family coverage. If you're 55 or older, you can add an extra $1,000 catch-up contribution. And if both spouses are 55 plus, each one can add that extra $1,000, but only into their own separate account. Now here's what makes this account genuinely rare. It can give you 3 separate federal tax advantages on the same dollar. Your contribution goes in pre-tax, it grows tax-free while it's invested, and it comes out tax-free too, as long as you spend it on qualified medical expenses. A traditional 401k, for example, generally gives you 2 of those advantages, tax-deferred contributions and tax-deferred growth, but withdrawals are generally taxable. And here's a detail that's often overlooked. If your HSA contribution comes straight out of your paycheck through payroll deduction, it also skips FICA tax, Social Security and Medicare tax, which a 401k contribution does not. The exact savings depend on your tax bracket, state, and how you contribute. But for many workers, especially when the contribution runs through payroll, the combined income tax and payroll tax savings can make the upfront benefit meaningfully larger than a typical retirement contribution of the same size. Now let's talk about how to actually use this account the right way. Before anything else, you need to confirm you're actually eligible, because an HSA isn't available to everyone. To qualify, you need to be enrolled in what's called a High Deductible Health Plan, or HDHP, or, as of this year, a qualifying bronze or catastrophic marketplace plan under the new rules. For 2026, the standard HDHP minimum deductible is $1,700 for individual coverage, or $3,400 for family coverage. You also can't be enrolled in Medicare, and you can't be claimed as a dependent on someone else's tax return. If your employer offers a health plan during open enrollment that's labeled HDHP compatible or HSA eligible, that's your signal. If you're not sure, this is worth a 2-minute conversation with your HR department, because plenty of people go years without realizing the plan they already have qualifies. Once you know you're eligible, here's the mistake most people make with the money that goes in. Here's an uncomfortable truth. Most people who have an HSA never invest a single dollar of it. It just sits there in a low-interest cash account, quietly losing value to inflation every year, functioning exactly like a checking account instead of the investment account it's capable of being. Many HSA providers let you invest anything above a required cash balance. The exact threshold varies by provider, into the same kind of low-cost index funds we've talked about in previous videos. That cash cushion covers near-term medical costs. Everything above it can grow, tax-free, for decades. This single shift, from cash sitting account to invested account, is the difference between an HSA that barely keeps up with inflation and an HSA that could realistically be worth tens of thousands of dollars more by the time you retire. Now here's the strategy that genuinely surprises people the first time they hear it. Here's something almost nobody explains clearly. There is no deadline on when you have to reimburse yourself for a medical expense from your HSA, as long as you kept proper records. That means you could pay a $200 doctor's visit out of your own pocket today, using regular checking account money, and simply save the receipt. Meanwhile, that $200 stays inside your HSA, invested, growing tax-free, for 5 years, 10 years, even decades. Then, whenever you want, you can reimburse yourself for that old $200 expense, tax-free, while the money that stayed invested inside the HSA had years to compound. One important rule to be clear on: this only works for expenses that happened after your HSA was opened. You can't reimburse yourself for medical bills from before the account existed. The expense has to occur while you actually have the HSA established. People call this the shoebox strategy, because all you technically need to do is keep your receipts, digitally or literally, in a shoebox, and let the investment side of the account grow untouched in the meantime. Quick question for the comments: did you know you could do this? Or did you assume HSA money had to be spent the same year? Curious how many people are sitting on this without realizing it. A couple of situations worth clarifying, because they change your numbers directly. If your employer contributes to your HSA on your behalf, some do, similar to a 401k match, that contribution counts toward your annual limit, not on top of it. So if your employer puts in $1,000 and your individual limit is $4,400, you can personally contribute up to $3,400 more to hit the max. If you're self-employed or your employer doesn't offer an HSA-compatible plan at all, you're not locked out. You can open an HSA independently through providers like Fidelity, Lively, or your existing bank, as long as you're enrolled in a qualifying HDHP on your own. The contribution limits are exactly the same either way. The account isn't tied to your employer, it's tied to you. This matters because a lot of people assume HSAs are only available through work, and skip the account entirely if their employer doesn't mention it. This is where the HSA quietly turns into one of the best retirement accounts available. After age 65, the rules loosen significantly. You can withdraw HSA money for anything, not just medical expenses, and you'll simply pay regular income tax on it, the same way a traditional IRA works. No extra penalty at all. But if you do use it for qualified medical expenses after 65, including things like certain Medicare premiums, that money comes out completely tax-free. And unlike a 401k withdrawal, qualified HSA distributions generally aren't included in your taxable income. That matters because taxable income can affect whether you owe higher Medicare premiums through something called IRMA, the income-related monthly adjustment amount. In plain terms, qualified HSA withdrawals can keep that money out of the income calculation used for Medicare's IRMA surcharge, while taxable retirement account withdrawals can potentially push your income higher. And unlike 401(k)s and traditional IRAs, HSAs have no required minimum distributions. You're never forced to withdraw money on the government schedule. It just sits there, growing, until you actually need it. Once you shift from treating your HSA like a medical debit card to treating it like a real investment account, something changes. Doctor visits stop feeling like a place where money just disappears. Instead, Every dollar you're eligible to contribute becomes a dollar working multiple tax angles at once. Money you were already going to need for healthcare, just working harder in the background the entire time. It's not flashy. It's the same quiet compounding advantage we've talked about with index funds and retirement accounts, except this one comes with tax benefits those accounts can't fully match. If you haven't already gone through our video on the 2026 401k and Roth IRA changes, that's the natural companion to this one. Between the two, you now have the full picture of how to prioritize every tax-advantaged account available to you. And if you're ready to start investing whatever you put into your HSA, our index fund video walks through exactly where that money should go. Let's go back to that pharmacy counter, your card, an ordinary transaction. That same purchase, made through the right account, could have quietly worked multiple tax advantages at once instead of zero. That's the entire point of this video. You've seen it today. What actually makes an HSA valuable, the 2026 contribution limits and eligibility expansion, how to check if you qualify, while leaving the money in cash wastes its biggest advantage, the shoebox reimbursement strategy, what changes if you're self-employed or your employer contributes, and what this account becomes after you turn 65. If this was useful, hit subscribe for more data-backed breakdowns like this one. And let me know in the comments, did you already know about the shoebox strategy? Or is this brand new information? That debit card swipe at the pharmacy counter isn't just a purchase anymore. Now you know what it could have been instead.